Malaysia Airports Holdings has terminated the 742.95 million contract awarded to Pestech International to build and supply a new automated people mover, better known as the aerotrain project in KLIA. MAHB said its wholly owned unit Malaysia Airports Sepang issued the notice of termination of the APM to Pestech's wholly owned subsidiary, Pestech Technology. In a statement to the board, MAHB said that the termination is due to, amongst others, Pestech Technology's non-performance, compromising significant project milestones and risking delays to deliver the project within the required deadline. Following the notice of termination, which was preceded by a notice of default to Pestech Technology, MAHB said MA Sepang can proceed to recommence and complete the works through the engagement of other relevant parties with a focus on ensuring that the project is completed on schedule. MAHB says that it remains committed to assign the necessary resources in order to minimize any potential delays to the APM project. This confirmed an earlier report by The Edge quoting sources that the airport operator was planning to terminate the contract after Pestech failed to meet the timeline as it was more than 250 days behind schedule. To recap, Pestech's wholly owned Pestech Technology secured the job in December 2021, where the job scope included design, supply, installation, testing and commissioning of the APM and associated works. The possible termination comes shortly after IJM Corp announced its plan to take up a 44.83% stake in Pestech in a restricted offer worth 124 million in total, which would have made IGM Pestech's largest shareholder. Notably, the aerotrain contract was the biggest win for Pestech, which has been dealing with several issues as of late, including investigations by the MACC, which are understood to have been resolved. SP Setia's second quarter net profit declined 46% year-on-year to 43.06 million as the property developer saw higher finance costs and foreign exchange losses offset the group's higher gross profit. These downsides mitigated the group's operational efficiencies, which saw gross profit rise 13% year-on-year to 311.29 million, despite revenue declining 7.4% to 942.7 million ringgit. For the first half, earnings fell by 33% year-on-year to 98.5 million from 147.6 million, while revenue inched up by 1.3% to 1.91 billion from 1.89 billion ringgit. In a separate statement, SP Setia said it has secured total sales of 2.56 billion for the first half, equivalent to 60% of its FY 2023 sales target. The developer added that it has secured total bookings of 470 million as at June 30th, 2023, and that its key focus is to convert these bookings into sales in a timely manner. SP Setia currently has 44 ongoing projects and unbilled sales totaling 6.82 billion as at end June, giving it earnings visibility in the short to mid-term. President and CEO Datuk Chung Kai Wai says that SP Setia will continue to focus on delivering quality developments and sustainable solutions while continuing its plan to move towards a lighter asset structure and leveraging on its effective remaining land bank of 6,870 acres with a total GDV of 125.77 billion ringgit. He adds that the group remains confident of achieving its FY 2023 targets. Former Bank Negara Governor Tan Sri Dr. Zeti Aziz said the central bank stopped heavily indebted 1MDB from a grand scheme in 2014 to borrow even more money to the tune of 4.9 billion ringgit from foreign offshore sources. This was especially since 1MDB was still unable to provide any information in 2014 on what funds were invested overseas because there were none. Zeti, who was testifying as the prosecution's 46th witness in ex-PM Datuk Sri Najib Razak's 1MDB trial, told the court that there had been increasing suspicion over 1MDB and the dubious nature of its transactions. At the same time, BNM had to consider that the state-owned entity may have to keep money overseas to repay its foreign debt. Najib's lawyer Tan Sri Muhammad Shafi Abdullah had asked Zeti about the attempt by 1MDB to get BNM's approval to raise an additional 4.9 billion in 2014 by issuing more bonds. Zeti explained that based on increasing information from the foreign network of of regulators. 1MDB wanted to use the amount raised to pay off existing debt, even though it was unable to explain how it became so indebted. Zeti said 1MDB had appealed to B&M to reconsider its decision, only for the central bank to reject it, as 1MDB had incurred a high level of debt since 2009, which was a big problem for the country. Having failed at getting B&M's approval in 2014, Zeti said that 1MDB then tried to approach the Securities Commission for help for its fundraising needs, but added that she didn't know the details. Malaysia Marine and Heavy Engineering Holdings registered a net loss of 388.7 million for its second quarter versus a net profit of 22 million a year earlier, as cost provisions hurt its bottom line. In contrast, revenue spiked more than double to 1.06 billion from 406 million a year ago, mainly due to higher revenue from the engineering segment. For the first half, the group posted a net loss of 385.16 million compared to a net profit of 24.7 million a year before, while revenue improved 90% year-on-year to 1.55 billion ringgit. On its prospects, MHB said that the heavy engineering segment will continue to face challenges in executing ongoing projects within the originally budgeted margins due to the impact of raw material price escalations and global supply chain disruptions. Meanwhile, demand for dry docking activities is expected to increase as vessel owners prepare for a rise in seaborne trade requirements for the remainder of the year. MHB said it will continue to explore opportunities in both domestic and international markets, with increased emphasis on decarbonization and renewable energy. It added that it is also looking into ways to improve its contracting strategies with clients through the alliance concept or on a cost-plus basis, where possible, to mitigate the risk of global inflation for future projects. UEM Group has secured majority shares in Synergy SEA, a sustainable energy solutions company from sovereign wealth fund Khazanah RE, and plans to grow its new subsidiaries RE Business, Bernama reports. The group said Synergy, incorporated in 2008, specializes in reducing carbon footprint through investment in RE, specifically biogas, biomass and solar, as well as energy efficiency projects, and is Malaysia's largest grid-connected palm oil mill effluent biogas player. UEM Group in a statement also said that Synergy had a portfolio of 23 biogas power plants in Malaysia and Indonesia with a total generation capacity of 39.6 megawatts and 20 solar projects across Malaysia consisting of both solar farms and rooftop solar with a cumulative capacity of over 37.6 megawatt peak. UEM Group MD Datuk Muhammad Izani Kani commented that Synergy had a commendable track record with projects and presence across the country. He adds that they see immense potential in the company and are committed to nurturing as well as providing the necessary expertise, operational and financial support that will enhance its operation capabilities, secure more projects and usher in a new era of growth. Muhammad Izani pointed out that RE is one of the key sectors and immediate priorities of UEM Lestra, the green industries arm and wholly owned subsidiary of UEM Group, due to the sector's strong market attractiveness and high importance to Malaysia's decarbonisation agenda.